New Fed Chair Kevin Warsh just told reporters he can't tell us what comes next. That means Thursday's inflation number decides if we get a rate hike this fall. Monday, June 22, 2026. Like and subscribe for daily market updates. Today's agenda: the Fed flip, market snapshot, oil and gold mirror, the crypto squeeze, corporate spotlight, global risks, the week ahead. Up next, market snapshot. New Fed Chair Kevin Warsh just tore up the old playbook. In his first meeting as head of the central bank, he scrapped forward company outlook entirely. He told reporters bluntly that no one knows what comes next, because inflation is too sticky right now. The official statement shrank to roughly 130 words and swapped language about patience for a single promise: price stability. Look at the dot plot showing where officials expect rates to go. 9 of 18 policymakers pencil in at least one rate hike this year, while several see more than one. But the weekend wobbled with global news, so let's talk about oil and gold. U.S. markets were closed Friday for Juneteenth, so our last full session was Thursday, when stocks clawed back the previous day's slide. The S&P 500 closed just above $7,500, the Nasdaq jumped nearly 2% to around 26.5 thousand, and the Dow edged up to about 51,565. The standout was the Russell 2000, which surged more than 2% to under 2,980. Crypto is suffering from the same macro vise that crushed gold and oil. Crude oil has become this week's most volatile asset, posting significant declines driven by shifting global political risk premiums rather than fundamental supply shocks. West Texas Intermediate trades just under $70 per barrel, while Brent hovers near $80. Both benchmarks have retreated roughly 8% to 10% on the week as immediate fears surrounding the Strait of Hormuz dissipate. This correction follows a stark contrast seen in May, when oil spiked toward $100, fueled by panic over potential regional conflict and actual supply disruptions. That extreme unpredictable price swings was largely psychological, driven by the prospect that Iran could close this critical choke point, handling nearly 20% of global seaborne trade. Now, traders are quietly rerouting crude shipments through alternative passages or leveraging increased inventory buffers to bypass the strait entirely. This strategic rate change effectively neutralizes the threat premium, forcing prices back towards supply-demand underlying health rather than war hysteria. The mechanism at play is a rapid repricing of expectations, where market participants realize that even if tensions flare, logistical workarounds prevent actual shortages from materializing instantly. Historically, oil markets have shown an uncanny ability to absorb global political shocks once alternative routes are confirmed viable, as seen after the 2019 tanker rerouting around Africa during similar threats. As this fear fades, investors face a concrete reality. Capital previously deployed for defensive hedges in energy sectors must now be reallocated toward growth stocks or fixed income, where yields offer better protection against rising inflation without global political drag. For portfolio managers, the implication is clear. Holding long positions solely based on war narratives becomes increasingly dangerous as those premiums bleed out fast, leaving only genuine production data to drive future price action. That brings us to corporate spotlight. Bitcoin remains trapped in a grinding consolidation near $64,000, stubbornly hovering below the psychologically critical threshold of $65,000 and significantly undercut its 200-day moving average around $82,000. This stagnation is not an isolated sector-specific anomaly, but rather a direct consequence of the broader big-picture economic vise raising interest rates on risk assets globally. The primary mechanism driving this capital rotation is the stark opportunity cost presented by cash yields exceeding 4% in virtually zero-risk government bonds or high-grade money market funds. When investors can park available cash in the market at such attractive rates without exposure to unpredictable price swings, equity and crypto markets face immediate selling pressure as portfolios rebalance towards safety. This dynamic mirrors historical cycles seen after previous rate hikes in 2018 and early 2023, where digital assets were the first to capitulate before broader market corrections took hold. The second-order effect here is a fundamental shift in asset allocation strategy. Institutional money managers are increasingly treating Bitcoin less as an inflation hedge and more like a speculative growth stock that must outperform risk-free rates to justify inclusion. For investors holding long-term positions, this environment demands patience, but also vigilance regarding portfolio drift towards safer havens. The implication is clear. Until the cost of capital drops or alternative yields compress, any rally in crypto will likely be short-lived and fragile against a backdrop where cash remains king. Overseas tensions are still driving inflation expectations right now. SpaceX has captured global financial attention as a potential game changer for private enterprise valuation models, though its market reality is more complex than headlines suggest. The company's record-breaking $75 billion IPO debut occurred just before the long weekend with immense fanfare, positioning itself alongside legacy tech giants that historically took decades to reach such available cash in the market milestones. However, subsequent trading revealed immediate unpredictable price swings as early momentum evaporated. Within hours of opening, shares slid significantly from initial offering prices. This rapid correction indicates retail investor FOMO clashing with institutional caution regarding valuation price-to-earnings ratios defying traditional SaaS or aerospace metrics. For the average buyer chasing the open price for instant gains, current market action means they are now roughly breaking even, after accounting for transaction costs and opportunity cost over this brief window. This dynamic mirrors historical tech IPOs, like WeWork's disastrous 2019 launch, where astronomical how expensive assets look relative to earnings collapsed under scrutiny before operational data could validate them. The mechanism is clear. Without sustained earnings growth or a proven path to profitability in the near term, even revolutionary technology struggles against gravity-defying price expectations set by hype cycles. Second-order effects include increased skepticism toward non-traditional IPO structures and potential regulatory pressure on how private firms transition to public markets. Investors must distinguish between genuine asset appreciation driven by technological disruption versus speculative bubbles fueled by social media narratives. The concrete implication for portfolio managers is a sharp rate change from chasing high-flying debuts to demanding rigorous fundamental analysis before committing capital, as the days of easy money in initial offerings appear permanently altered by this latest market test case involving one of humanity's most ambitious engineering feats. So here is where we stand on the biggest risks facing your money this week. Global political unpredictable price swings persists as last week's diplomatic breakthroughs quickly reverted to uncertainty. The US and Iran formalized a 14-point memorandum extending the current ceasefire, yet its fragility became evident when follow-up negotiations in Switzerland were abruptly canceled before starting. Despite European mediation efforts, talks resumed only under significantly stricter conditions than Tehran originally proposed. Tensions escalated after President Trump issued an ultimatum warning of imminent military strikes unless Iran curtails support for proxy networks in Lebanon and other regions. This marks a critical rate change. Unlike previous pauses allowing gradual de-escalation, current rhetoric suggests a potential return to kinetic conflict if red lines are crossed again. Historically, such threats precede market dislocations, as seen when 2018 and early 2023 tensions triggered rapid sell-offs in emerging markets dependent on Middle Eastern energy flows. The mechanism is clear. Any perception of escalation spikes oil prices, while depressing global equity, how expensive assets look relative to earnings due to supply chain disruption fears. For average investors, second-order effects are already materializing. Regional stability uncertainty forces a re-rating of risk premiums across asset classes, particularly for nations bordering conflict zones. Consequently, portfolio managers must adopt hedging strategies accounting not just for direct military action, but also the cascading economic penalties associated with prolonged Persian Gulf instability. Finally, let's turn to the week ahead. The market sits in fragile optimism, perched on three critical economic catalysts ready to tip the scales. This cautious investor mood reflects active digestion of recent data suggesting inflation remains stubbornly entrenched despite aggressive Federal Reserve rhetoric. The immediate flashpoint arrives Thursday with the Personal Consumption Expenditures Report, a key gauge for core price stability. If this PCE print runs hot, confirming persistent demand pull pressures rather than supply-side shocks, implications cascade instantly through every asset class. A confirmed inflationary spike would cement Jerome Powell's successor, Philip Warsh, in his in favor of higher rates stance, likely triggering an immediate rate hike decision markets have been attempting to price out of existence. The mechanism is straightforward, yet brutal. Higher rates increase borrowing costs for corporations and consumers alike, compressing profit margins across the S&P 500, while simultaneously driving yields on treasury bonds higher as investors flee growth stocks for safety in fixed income. This dual pressure creates a negative feedback loop that historically decimates risk assets. We saw similar unpredictable price swings during the 2018 trade war, when unexpected inflation data forced rapid pivots, wiping out hundreds of billions from equity. How expensive assets look relative to earnings overnight. Consequently, crypto markets, often acting as high beta proxies for tech stocks, would face an immediate available cash in the market squeeze alongside traditional stocks and bonds. For investors holding long-term positions, this scenario demands strategic reevaluation. Defensive positioning becomes paramount, while duration risk in portfolios skyrockets. The window to deploy capital, before potential policy raising interest rates closes, is narrowing rapidly, requiring precise timing rather than broad speculation as the Fed prepares to shift from talk to action based on these hard data points. The mood is cautiously constructive, but it is balanced on a knife's edge of three catalysts. The single biggest risk is Thursday's PCE running hot and cementing a Warsh rate hike that would jolt bonds, stocks, and crypto all at once. I think the market is underestimating how in favor of higher rates Warsh will be until PCE drops below 2.8% next week. Thanks for watching Market Pulse Daily.